Okay, guys, welcome to today's video. Today's day 30. Yeah, we have been doing this for the past 30 days. I'm so excited. We have 70 days to go for this challenge. If you're just coming across this video for the first time, you want to do well to go and watch this video from the challenge. You want to really learn SMC because I've been really following the videos based on step by step basic. Okay, so you start from the beginning. So if we were to look at what we have done so far, we have actually learned a lot about SMC and trading the SMC strategy. But in the next 70 days, now we are going to be going into advanced SMC, right? We have talked about the basics so far, understanding our structure. Now we are going to be leading you to guidelines for you to now perfect the trading strategy very, very well, how to master it so that you can be a profitable trader. So if you're coming across day 30 for the first time, go and start from day one and you're going to really, really enjoy it. So today we're going to be talking about structural and engineered liquidity and how we can identify them so that we can use them to trade. Okay, so it's basics, it's the simple thing. We all know that in SMC, right, our major what we look out for is market structure and liquidity. Right, once we know the market structure, we understand the direction of the market, we look for zones where money is resting, then we target liquidity, we pick out our point of interest, then we buy or we sell. So in the aspect of liquidity, I've done two videos in the past talking about where I did introduction to liquidity. So I will not be really going into explaining what liquidity is or not in this video. If you want to really understand it, I think go to, is it day 5 or day 6 video we talked about liquidity, right? Now, you know that if market is moving, we talked about two ways in which market move, right? Either in an uptrend or in a downtrend or in a ranging market. So three ways, right? But smart money traders want to either buy market when the market is an uptrend and you want to sell when the market is in a downtrend. So you need to understand the structure first. Now, how is a structural liquidity formed? It is formed when market moves in an uptrend. And engineered liquidity, sorry, not even when market either an uptrend or a downtrend, right? When market is forming a structure of buy or sell. So it's not majorly uptrend. I mean, in the structural market of say, be it uptrend or downtrend, right? Now, while engineered liquidity is usually formed when market does not have a structural liquidity and market wants to actually the market makers want to actually manipulate price. It's either they want to manipulate early buyers or early sellers. They engineer a liquidity before buying. I'm going to explain everything before buying or selling, right? If I'm using buying, just know that it's for both buy or sell, right? So for example, we know market is in an uptrend. For this structure, we have market creating, right, higher highs and higher lows, but we know typically this is not how the market moves, right? Say for example, market moves this way, right? We have higher high, higher low, higher high, higher low. Now instead of market to create a higher high, right, market creates a high, right, then creates a low, then creates a high again, then continue moving up, right? Now, especially when the market is in an uptrend, you know, they have two forms. I explained also two forms of structure, right? We have continuation entries for SMC setups, and we also have reversal entries. It means if market's in an uptrend and we see retracement, we can catch market to the upside. Or if market is in an uptrend, then market wants to reverse completely to a downtrend, right? We can also catch setups. So for this, if you look at this move right here, most times this is the what and structural liquidity. Now when you have market creating a swing high, a swing high, a swing low, a swing high, a swing low, now the structure where market breaks structure, right, this is the swing. Let me mark it very well so you guys will understand this and make it neat. Okay, good. Now this is the swing low, right? But market was moving close to the swing high, but could not, right? We had a resistance around this region that pushed market to the downside. Then before market now breaks structure. Okay, but this was the previous swing low that created a high, a low before the break of the structure, right? Then market continue moving in an uptrend. In scenarios like this is called the structural liquidity. Now, if market wants to continue moving in this swing, you have scenarios where market would come down, take out this structure, tap into the main swing low, then buy. Remember I said we are going into more technical aspects of SMC, right? More technical aspects of SMC so that you begin to see all these things more clearer on the chart. Okay? When you see a move like this low was the one that actually took out this high, right? Most times you have markets coming down here to buy from this low to push market to the upside, right? Most traders can catch this move because a low here broke structure. They will catch a move here. We'll come to that. But for this video, we're talking about structural. Now, this low is usually a structural what? Liquidity, right? Because it was not the initial low that started this swing move, right? The initial low that started this move was resting just below. And sometimes to confirm this move, there will usually be a what? An FVG below, right? There will usually be a fair value gap. The market failed to fill in completely before buying to the upside. Then all of a sudden, market continue bullishly, then taps into a resistance zone. Then markets will start retracing back to this region. Lots of people would be buying here, right? Because to them, this was the low that broke structure, but it was not the initial swing low from the higher high, right? Then market will react here. It will react, definitely it will react. Then all of a sudden, it will break and take them out because it's serving as an liquidity zone. Then tap into this region where the buy actually started from, right? Where this swing low stopped, then the buy will continue. So you can see this happening over and over again. So this form of liquidity is called structural liquidity. It is formed when market was creating the structure of higher highs, higher lows, higher highs and higher lows, or lower highs, lower lows. The same thing in a bearish scenario, right? The same thing happens in a bearish scenario like this, right? You see markets selling, then all of a sudden this particular low or this particular high tried to break this low, it could not. Then it retraced, then this one now came to make the break of structure to the downside, right? Usually in a continuation trade. Then all of a sudden market still retrace into this low. Let me make it very neat so you guys can get it clearly. Then all of a sudden market still retrace into this low and sells, right? So once you see something like this, right, if market is retracing back up, right, it usually use this high as a structural liquidity, tap into this region, then sells. This will now be your point of interest, not this. And a confirmation would be a fair value gap around this region also. So this would serve as the what? Structural liquidity, right? You see this happening over and over. How did you know? How would you know? You need to look at the points, right? Look at the structure, how market has been moving, and most times market would even create like a mitigation. It might mitigate whatever point of interest you want to buy from here before making the move, right? Before making the move to the upside. And also most times when market creates this structural inducement or this structural liquidity, it does not even come down to the 50% level of this initial swing, right, before the market buys. So there are so many things to look out for. This swing low to this swing high before the retracement starts, market does not even usually come to the 50% level. It will just stop somewhere in between, then all of a sudden breaks that structure, right? So the discount move of this swing would not be complete. You see that most times if market is coming back down, it takes this as structural liquidity, then tap into this POI where the initial buy started, the initial swing low started from, then market will buy in a continuation, right? In a continuation trade. Now, scenarios also happen for engineered liquidity, right? You see a scenario like this. When market is creating higher highs and higher lows, we want to buy, right? Market created a protected low for us by sweeping this liquidity of the previous low. Okay, let me make it clearer. Say we have structures like this, market creating higher highs, then all of a sudden we saw a sweep of the previous low, market makes a bullish move. Now there's a protected low here, and for SMC, once we want to buy from an order block, we ensure that that order block has taken out liquidity before, so that it is now protected. But what happens when the market just boom? Now this is swing low to swing high. There is no structural liquidity, right? There's no structural move. That means there's no internal move. So what happens? What do we wait for? We need to wait for market to create a form of what? Engineered liquidity, right? How would market do that? Market needs to come, right? Make a move towards our point of interest, engineer liquidity, create a form of inducement, right? Create a form of retracement. This is the form of inducement now. It will come like this, right? A lot of people would want to buy from here. You see a rejection to the upside, then all of a sudden a sharp drop to your POI, then market buys, right? This move is called what? Engineered liquidity. Now this engineered liquidity most times will not create a break of structure to the upside, right? If it creates a break of structure, it's now structural, right? Now most times it will just induce. We have talked about it severally, but we did not identify it as engineered or structural. But now I'm identifying it for you as engineered or structural. You see market creating an impulsive move, right? But there's no liquidity. All you see there is a point of interest that has a fair value gap, but no liquidity sweep. Market did not create equal highs, equal lows, whatever. So at that moment now, market would come to engineer liquidity. It means to create a form of inducement that, oh, we are buying. Then all of a sudden, market will now retrace back to take out this previous low and buy, right? Most times also you can have two equal lows as engineered liquidity form. When you see movement like this, market take out the low, high, market will engineer. You see a move, you see another double low, right? Two equal lows, the market buys like this, then all of a sudden a retracement to the lower, sweep that engineered liquidity, then you see a push to the upside. You can see this move happening over and over again, right? Where there was no form of structural liquidity in there, right? None of the liquidity created a second break of structure to the upside. But now for this move, you must be very careful, right? You must be careful when trading this move. You trade this move most times when the market is in a continuation, where you want to catch a continuation trade, not when the market is trying to reverse, when it's a reversal setup. Say market was in a downtrend, then all of a sudden market creates bullishly, right? If market was in a downtrend, that's where a lot of people get this thing wrong, right? When we see engineered liquidity like this, and we want to see something like this when the market is on an uptrend or a downtrend. So this is a continuation move, not when you want to catch reversal setups on SMC. It means market was completely bearish, right? Market was completely bearish, then all of a sudden a market structure shift happens, right? A market structure shift happens. If I want to buy, I would need to see market creating a structural liquidity for me, right? That means I'll need to see a break of structure, like a break of structure form. Why market was entirely bearish before. Now I have a market structure shift. I would want to see a break of structure before what? Buying. So I want to see a structural liquidity here, not an engineered. So for this form, when market was reversing before, if I want to buy, I need to see a structural liquidity available, not induced, not engineered, right? I trade, okay, say for example market was bearish, all of a sudden market structure shift happened, right? I want to see if I want to see, what am I looking for? Look at this structure. Okay, look at this structure. Market was bearish, say 1 hour time frame, 4 hour time frame. We are bearish. Then all of a sudden, the market tapped into a high demand, right, on the higher time frame, right? Then after that, we now saw market disregarding the previous low, right? Market disregard the previous low, we mark it as what? We say this is a market structure shift, right? Now, what do I want to see if it's a reversal? Because at this point, the market was completely bearish, right? I am not expecting the market to create an engineered liquidity for me at this point in order for me to buy at this POI. I don't want to see this. I don't want to see market doing this. Before I buy. Nah, this is not what I want to see. If I see something like this, most times on the reversal trade, I would not take this trade. And I'll explain why. What I want to see is market doing this, right? Coming into this place, creating another break of structure for me. I want to see that structure, right? Completely break. Then I want to see market coming back down to the POI or any point of interest here, then buy. So I want to see structural liquidity here for me to grab, right? Not an engineered. Why? Because this is a reversal trade. Now, if all I'm expecting to see is an engineered, what if this might just be market taking out an engineered or structural liquidity for the sell side? Now, market has only disregarded a previous high, which is this. Now has tapped into a sell order block, which you have seen here. What if this is also a sell continuation trade? Then market just wants to use this particular high as a structural liquidity to sweep to continue the sell side move, to continue selling to the downside. So if I enter a trade like this, I would be trapped. Then all of a sudden, I'll be like, market has created the market structure shift now. This POI is supposed to hold. Why? This POI also swept liquidity like this. You say this POI swept liquidity, it creates market structure shift. Then all of a sudden, you want to catch a buy trade. The market will take out the point of interest. Why? Because it is using this other region as a sell POI for a sell continuation, while it's taking this out, right? So that's why I don't want to see a form of what? I don't want to see an engineered liquidity here, right? I don't want to see an engineered liquidity where market is creating something like this here. Maybe it comes here, now do something like this, right? And then I want to buy. No, I don't want to buy like this. Why? I don't want an engineered liquidity right here, because this might just be a bearish continuation. Then all of a sudden I'm buying here, the market takes me out. So what do I want to see? I want to see market creating this move like this and create that structural form of liquidity for me like this. So when I see a second break of structure, then good. If market decides to retrace back to this region, it will take me out as what? This point of this low as liquidity, and tap my point of interest, then buy. This is how I want to catch a reversal SMC setup. Do you understand? So this is what affects most people when you see it, this is a clear SMC setup. What happened now? There was a market structure shift and market creating inducement still. Then all of a sudden, what market was actually wanted to do was taking this sell, this high as structural, tapping into another sell side for a sell to the downside, right? So you need to know the difference. You need to understand the difference, right? So most times I use engineered liquidity for continuation trades, right? Identify when market creates an engineered liquidity, it's for continuation, maybe an order flow trade, but not when it's a reversal setup. I don't know if you guys understand the difference now, right? Not when it's a reversal. I think we talked about order flow in our previous videos, where you already catch a buy setup and you can continuously catch more buy setups. Now I can continuously catch more buy setup. Even if I'm seeing engineered liquidity, I will trade off it, right? If I see engineered, I'll trade off it. But now, if the market was totally bearish before and it was the first move, right? The first move market decided to change structure, I will not be looking out for an engineered liquidity. I will be looking out for structural liquidity. I want market to create that two break of structure to the upside before retracing to the downside for a buy continuation. The same thing on a sell scenario when market is actually in a downtrend and wants to reverse. So you guys need to also understand this thing. In our next video, I'll be taking you to the chart where I explain all these scenarios happening live, right? So you want to go and backtest structural. Most times, mostly, I want to see it when you can see structural liquidities even on a continuation trade, right? You can see structural liquidity even on a continuation trade. I'm not saying it's impossible, you'll not be able to see it in the market. You will see it definitely. But what I'm saying is, if it's a reversal trade, I want to see structural, not engineered, right? I want to see markets creating a break of structure again and taking this low, right, for a shift. I don't want to see markets doing something like this, right, where trying to create engineered liquidity. No, when there was no structural form of liquidity there. I don't want to see that. Okay, so thank you very much, guys, for watching. The next video will be continuing from here where we stopped. Remember, SMC, in order for you to master it, you must master market structure. If you do not understand market structure, you can never understand the concept of liquidity, right? That's why when I started this challenge, I took out, I think, 2 days or 3 days to talk about market structure. So if you are finding most of these things difficult, identifying liquidity zones or whatever, you need to go back and try to understand market structure. Go and watch my market structure video over and over again, right? When you understand how the market moves, the behavior of the market first and foremost. Remember, SMC is a wonderful strategy in order for us to catch precise what entries and exits. But we need to understand structure on higher time frames in order to determine the direction of where we are going to be looking for our trades. If your direction is not right, you are still going to be seeing two different setups, right? If this market on a higher time frame is bearish, you are still going to be seeing buy setups, and most of those buy setup will be invalidated. Why? Because of the higher time frame structure. But if you are seeing setups that matches with the higher time frame structure, you are going to be getting successful trades. And by higher time frame, I mean from the daily, from the weekly, from the monthly chart. That's where you want to get your directional bias before coming to lower time frame to look for what SMC setups. So thank you very much, guys, for watching.